welcome on board Dharmesh Kant as well and figure out what he's recommending doing in this market. Dharmesh, hi, morning. Dharmesh, while one can get pleased about the market movement yesterday and the little bit of a rebound, but do you sense that the poison is largely out of the system, or are the markets still digesting all the news flow from West Asia?
Yeah, good morning to you. I don't think the poison is out of the system. I mean, there are two parts to it. Before this West Asia crisis happened or the Anthropic event happened, the market was already under pressure. There was selling happening, despite Q3 numbers being good in anticipation that numbers are likely to be better. So the point what I'm trying to make is whether 12 to 15% kind of an earnings growth is good enough for our 2022 times of PE multiple on the indices, which I think is undergoing a resetting kind of a flaws. Last 1.5 years is suggestive of that. Having that in at the backdrop of the entire scenario, these news flow, just fashion up or hurry up the selling pressure which is there in the market. So West Asia is still, I mean, very early stage. Doing Iran for over 20-25 years, they have a tendency to prolong the war and they don't give in easily. Iraq-Iran war is a testimony of that. So this is going to, aggravate and extend further. So the headwinds in the form of supply-led inflation is likely to be there. How it is to be negotiated is again a ad hoc kind of a mechanism, and we will be reacting to day-to-day news in the market. So the selling may slow down. It may not be as I mean, the capitulation may not be there from here on, but the likely rise in the market is not expected. So we are, very cautious on the market. Only few sectors which we will be buying on declines, and those are like banking is one space where we still feel there is a lot of scope out there. Banking, infra, building materials, metals, and automobiles to a certain extent. Other than that, just to stay on the sidelines and watch how things unfold.
Dharmesh, how do you look at some of the defense stocks now? I mean, we've seen many of them rallying. Some of the shipbuilders have been rallying as well and have positive news coming in.
Yeah, good morning. I mean, see, what happens for defense company is like we have been bullish on the sector for last 2 years. Though last 1 year has not been good on the stock price front, but the momentum as far as the order inflows was there is still there. I mean, there's a continuity of order intake coming in, and the run rate of execution of say 12 to 15%. That is a feasible run rate, which is doable for defense companies. They have been doing that, except BEL, because it's more of a day-to-day supply kind of a company. So their execution is first faster. But say Bajgao Dock or a Cochin shipyard, or for example HAL, they are building ships and aircrafts, which helicopters, combat helicopters, which takes time. It's not that in 1 or 2 quarters the delivery can be there. So long term, we are very bullish on that. I mean, the order book itself is 4.5 to 5x of the bill ratio. And the margins have been improving because more of the input is being now manufactured in India. So the Make in India concept, almost 60% of the components going 2 years down the line will be manufactured in India. So that's a thematic structural play. So what the strategy is, wherever there is a decline because of any adverse, reporting by few brokerages or anything like that, or 1 or 2 bad quarters, you should buy there. Don't buy it on the rally. And the top pick still remains BEL and HL. So and Majgaon. So these are the three counters where we think if you are a holder for 2 to 3 years, very good prospects out there. And it's a solid counter because these orders will get executed and the numbers on the P&L will be there for you to see.
Okay. Dharmesh, I wonder, so hi, very good morning. What would the portfolio currently tilt towards? Say you were tilted towards export facing, given all of the FTAs that India has signed and all of the trade deals that India has gone through with. Would you bother changing the tilt of the portfolio at this point? Would you hold on to those? Would you now look at more domestic facing kind of sectors and segments?
Yeah, good morning, Harsh. I mean, we were always domestic facing. We have
Right.
never, tilted our portfolio based on FTAs being signed because it's been signed. I mean, 1 year down, it's 1 year more is there for things, the fine print to come out and how it is being negotiated. And Europe is a very tough country to trade with because there are so many, environmental norms and other human rights norms are there. To adhere to that becomes very difficult for groundwork of Indian companies to comply with, and that is where the real challenge is. We have seen that in the past. It has happened with a couple of good companies in India facing the challenges on the supply side to the European nation, and I think the things won't be easier. And now, since tariff of US is again subject to everyday change, every 3 or 4 days, it's been changing. So 25%, 15%, 10%. Now again they are saying 15%, and then 5 months down the line it will go up. So but this is one theme which you should totally ignore and avoid. I mean, you can just be lucky that you contemplated and things played out your way, and then things may turn out. But the safest is inward facing domestic economy, and there we think the infra space will continue to do well, the cement will continue to do well, metals, the domestic manufacturers will be having a business at their hand. At the same time, because banking is a proxy to all, it will be going, it will garner business. The only thing which we now think should be avoided to a certain extent is the NBFC space, because interest rate down cycle is likely to be paused at least for this year in light of what is happening, and inflation may pick up going forward. So there will be some cost of funds being hiked up for the NBFC space, not for the banking space, because they are largely deposit led liability side, so they would be better off. So the very basic structural economy facing sectors is what we are bullish on. Automobiles you still double in kind of declines.
Quite interesting views on NBFC there. Kunal, let's pick up on banks, because the divergence between private banks and the larger ones, as well as the PSBs, is only getting more and more, sort of stark as the days go along. Having said that, even SBI and some of the PSBs too have fallen since Monday. What do you read on the charts now?
So yeah, there's some bit of element, that the PSU banking stocks which are holding forth, they've started to show signs of weakness. I would still believe that maybe it could be because of the weight of profit booking right now, rather than building up a fresh short positions, because had that happened, you would probably have seen a bigger intensity of sell-off for many of the PSU banking names, or at least to start off with, maybe few of the select PSU stocks, PSU banking names, which have done very well for themselves. So I would probably sense that this could just be a profit booking bout from this pocket to try and mark or manage the M2M from the other sectors as well as other individual stocks. But I think what matters over here from the banking index, from the Bank Nifty perspective, is the previous major support, and that level is around 57,750 for the bank index on the spot levels. If that support gets broken, then I would believe that you might probably enter into a phase where the private sector banking stocks could continue to be weaker for themselves, but the PSU banking stocks which are holding forth from a round of profit booking, that would convert into a sort of a pressured downtrend for many of these PSU banking names. So far, I think we are still holding about those support levels by at least around 1,000 points for the Bank Nifty. But if that gets taken out, then I would believe that the second round of selling could start off in the PSU banking names.
Okay. All right. So that's the take on private versus PSU. A couple of stocks in focus likely today on the back of everything that's playing out is Somani Ceramics coming out, excuse me, and suggesting that 50% of their power supply will likely get impacted because of gas not coming in. So that is one. You'll also see some impact on industrial supply of gas in India, and as a result, you will see some impact on certain sectors and pockets. Man Industry is saying that they do not foresee any material impact on operations. They had operations which were likely to start in Saudi Arabia, a manufacturing facility in Saudi Arabia, which was expected to start. I wonder whether that also gets impacted, does not get impacted, because they continue to suggest that there's not going to be a material impact. But those two stocks or companies came out with clarifications, and you might see an impact on those counters as a result of the clarifications coming through. So those two also on our radar. But of course, the defense counters, Kunal, those stocks also on our radar this morning. What's the take like? I know BEL is your favorite. I know yesterday you called out on BDL as well. But what about the likes of a Mazgon Dock, the kind of move that it showcased yesterday, along with some of the other shipbuilding stocks, a Cochin, a GRSE and the like? Are those on your radar as well?
Yeah, definitely. In fact, now I think the basket could get a little bit more wider for the defense names. So earlier, I think BEL was one of the strongest one, of course. But I think you would probably now enter into a phase where the leader is already established for the sector, but there are other stocks within the space which would start to look very attractive purely in terms of risk reward. Now, when you look at a very simple statistical measure over here, that how far these stocks are from their respective 200 moving averages, you would find that BEL is trading at almost like a 10% to 15% higher than its long-term moving average. Most of the other names, Massgaon Dock, even HAL to a larger extent, Cochin Shipyard, GRSC, etc., they are trading at almost 15% to 18% divergence from its long-term moving averages. So both of them are at extreme ends. Now, there comes a point where when the leader continues to make a new high for itself, like what we saw for BEL, there would be the underperformers which would try and play a catch-up for themselves. So I think we have now entered into that phase where potentially these underperformers would try and play a catch-up. So for someone who has that high risk, high beta element in terms of risk-taking ability, I would believe that Massgaon Dock, GRSC, BDL, etc. I think these are stocks which one could look out for purely in terms of mean reversion. Even if it's a minor mean reversion, you might probably expect that these stocks can swing at least 5 to 10% higher from where they've closed yesterday. And if it's a big uptrend which starts off for the defense counters yet again, then you might see a much more bigger move into these underperforming names.
Okay, that's that on the defense pack. But let me bring on board Karan and highlight some of the other newsmakers this morning. Karan?
Well, starting off with DCX Systems, the company has secured an order worth 68 crores from Hindustan Aeronautics Limited for the manufacture and supply of custom-made antennas and power supplies for airborne applications. Remember, this company's order book stands around 3,000 crores, and the company has recently announced the expansion of its manufacturing capacity with the addition of oversized PCB assembly capacity. So do watch out for that. Next is Titagarh Rail. Its Italian entity has sold a business unit to another Italian entity for a consideration of 66 million euros, which translates to around 600 crore rupees. Next is Dr. Reddy's Laboratories. The company has received the US FDA EIR for its formulations manufacturing facility in Andhra Pradesh, closing the inspection with a positive outcome. Followed by quarterly earnings from Fractal Analytics, the company has reported a good set of numbers with the EBIT margin expanding by more than 292 basis points and PAT recording a growth of around 200%. Next is Samhi Hotels. The company has announced the acquisition of a 70% partnership interest in Rare India, an aggregator of luxury conscious living hotels, for 47 crores. Remember, this hotel chain operates around 31 to 32 operational hotels and over 4,800 to 5,000 keys across 13 to 14 cities. Next up is Lemon Tree Hotels. The company has signed a license agreement for a new 49-room property in Himachal Pradesh, marking its 10th hotel in the state as a part of its strategic expansion into the North Indian leisure destinations. Remember, Lemon Tree Hotels is India's largest mid-priced hotel chain, operating more than 100 hotels with 9,700 plus rooms across 60 cities. Next is Zaggle Prepaid. The company has entered into a strategic 3-year agreement with Blue Star Limited to implement its specialized Zaggle Safe platform. And lastly, we have GK Energy. The Maharashtra State GST Department has concluded its 6-day search at its registered office on 4th March, alleging certain ITC violations to the tune of 7 crores, which the company intends to contest legally.
Okay, thank you so much for that, Karan.